Silver didn't just fall, it collapsed with precision, then reversed with equal violence, all within hours. The headlines blame Fed chatter. But the headlines are lying to you. What actually triggered this wasn't on any newswire. It was buried in the market's plumbing, in margin calls most analysts will never see, in physical premiums that tell a completely different story. 3 technical conditions just aligned, and the same 3 that marked every major bottom since 2020. But here's what nobody's telling you. 2 of them are already breaking down, and if the third one fails in the next 48 hours, welcome to your OG John A.G. Now I need a small favor from you, and I'm asking this the way I had asked my own grandfather to pass the salt at Sunday dinner. Could you kindly hit that subscribe button just 1 click? That's all. It helps us keep telling you the stories Wall Street doesn't want explained. And before we dive deep into what just happened in the silver market, drop a comment right now. Tell me where you're watching this from. Your city, your country. I want to know who's paying attention while the rest of the world sleeps on this. Now, let's talk about what really happened. February 2025 will be remembered as the month silver reminded traders what real volatility looks like. On a quiet Tuesday morning, the silver market opened with no warning signs, no dramatic headlines, no geopolitical shocks. Within 6 hours, it had fallen nearly 4%. Then, before most analysts could even publish their explanations, it reversed, not slowly, not cautiously, but with the same aggression it had fallen with. By Thursday's close, silver had erased almost the entire decline, leaving thousands of traders staring at their screens, wondering what they had just witnessed. This was not normal market behavior. This was something else entirely. The numbers tell part of the story. Silver dropped from approximately $32 per ounce to just above $30, then clawed its way back to $31.50 within 48 hours. A 4% fall followed by a 5% recovery. For most assets, this would be considered extreme. For silver, it was a reminder of why this metal operates in a category of its own. But the speed was only half the story. What mattered more was the pattern. Traders who have watched silver for decades recognize something familiar in this movement. The descent was sharp, clean, almost mechanical. It wasn't the slow grinding decline of a market losing confidence. It was the violent purge of a market clearing out excess positions. Large sell orders hit the futures market in concentrated bursts, pushing price through technical support levels that had held for weeks. Stop-loss orders triggered automatically, creating a cascade effect that accelerated the fall. Within minutes, the market had moved further than it had in the previous 2 weeks combined. Then, silence. For approximately 90 minutes, silver simply stopped moving. It hovered just above $30, neither rising nor falling, as if the market itself was catching its breath. What happened next defied the expectations of nearly every analyst who had rushed to call this a breakdown. Buying emerged. Not retail panic buying, not emotional speculation, but large, deliberate accumulation. Someone, or multiple someones, decided that $30 was worth defending. The bids came in layers, absorbing every sell order that remained. And when the selling finally exhausted itself, the reversal began. Silver didn't crawl back up, it surged. Within 12 hours, it had recovered half the losses. Within 36 hours, it was trading as if the correction had never happened. This kind of price action reveals something critical about market structure. When a market falls and stays down, it signals genuine weakness, a shift in underlying fundamentals or sentiment. But when a market falls hard and snaps back even harder, it signals something different. It signals forced liquidation, not voluntary selling. It signals that participants with leverage were shaken out, while participants with conviction stepped in. The futures market told this story clearly. Open interest, the total number of outstanding contracts, dropped sharply during the decline. This means positions were being closed, not simply transferred. Traders were exiting, likely because margin requirements forced them to, not because they had lost faith in silver's long-term trajectory. Comparing this correction to previous episodes adds useful context. In March 2020, silver fell 27% in a single week as global markets seized up during the pandemic panic. In September 2023, silver dropped 8% over 3 days as the dollar surged on unexpectedly strong economic data. This February correction sits between those two extremes, not as catastrophic as 2020, but more violent than 2023. The key difference? The speed of recovery. In 2020, it took silver 3 months to reclaim its pre-crash levels. In 2023, it took 6 weeks. This time, it took 2 days. That speed matters. It suggests the market was not reacting to new fundamental information, but to technical factors, liquidity issues, positioning imbalances. When fundamentals drive a decline, recovery is slow because sentiment must rebuild gradually. When technical factors drive a decline, recovery can be instantaneous once those factors resolve. The physical silver market provided additional evidence. During the paper market collapse, premiums on physical silver coins and bars remained stable. Dealers reported no panic selling from retail customers. In fact, several reported increased buying interest as prices fell. This disconnect between paper and physical markets is a recurring theme in silver, and it raises a question that will define the coming weeks. If paper markets can be shaken this violently while physical demand remains firm, what happens when physical buyers become more aggressive? That question leads directly into the second part of this analysis, where the role of monetary policy and Federal Reserve positioning comes into focus. Because while the correction may have been technical in nature, the backdrop against which it occurred was anything but neutral. Every financial journalist in America blamed the same villain for silver's collapse, the Federal Reserve. Within minutes of silver's reversal, headlines flooded trading terminals worldwide. Fed comments trigger silver sell-off. Hawkish tone crushes precious metals. Silver plunges on rate expectations. The narrative was simple, clean, and almost completely wrong. Here is what actually happened. On the morning silver began its descent, a regional Federal Reserve president gave a scheduled interview to a financial news network. He said nothing new. He repeated the same carefully crafted language the Fed has used for months, stating that policy decisions would remain data-dependent and that the committee was committed to achieving price stability. There was no surprise announcement, no unexpected hawkish shift, no emergency policy change. Yet within 2 hours, silver was in free fall, and every analyst pointed to this interview as the catalyst. This is how narratives are born in financial markets, not from truth, but from convenience. Markets need explanations, and when price moves violently, any nearby event becomes the explanation, whether it fits the facts or not. Understanding what really drove silver's movement requires looking beyond headlines, into the machinery of monetary policy transmission. The Federal Reserve does not control silver prices directly. It controls overnight interest rates, which influence the entire yield curve, which affects the opportunity cost of holding non-yielding assets like precious metals. When interest rates rise, or when markets expect them to rise, holding silver becomes relatively less attractive compared to holding bonds that pay interest. This is economic theory, but theory and reality often diverge in meaningful ways. In the 3 months leading up to February's correction, the Fed had held rates steady at 5.25 to 5.50%. Inflation data had moderated but remained above the Fed's 2% target. Employment reports showed resilience despite higher borrowing costs. The market had priced in a roughly 60% probability of a rate cut by mid-2025, down from 80% just 2 months earlier. This shift in expectations created a headwind for silver, but it was a slow-building headwind, not a sudden shock. The Fed interview changed nothing about this baseline reality. So why did silver choose that exact moment to fall? The answer lies in how markets process information under stress. Silver had rallied aggressively in January, climbing nearly 12% in 4 weeks. This rally was driven partly by safe haven demand, partly by industrial consumption forecasts, and partly by momentum traders chasing performance. By early February, positioning had become stretched. Speculative long positions in silver futures had reached levels not seen since late 2023. The market was crowded, one-sided, vulnerable. In such conditions, markets do not need major news to reverse. They only need an excuse. The Fed interview provided that excuse, not because it contained new information, but because it gave hesitant traders permission to take profits. This distinction is critical for anyone trying to understand what comes next. If the sell-off was genuinely driven by shifting Fed policy expectations, then silver's recovery makes no sense. Nothing changed about monetary policy between Tuesday and Thursday. The same Fed official who gave the interview on Tuesday was still saying the same things on Thursday. Yet silver reversed completely. This tells us the Fed narrative was superficial. The story markets told themselves to rationalize price action that had deeper structural causes, but dismissing the Fed's role entirely would be equally wrong. Monetary policy still matters enormously for silver, just not in the simplistic way headlines suggest. What matters is not what the Fed says on any given day. What matters is the longer-term trajectory of real interest rates. Real interest rates, nominal rates minus inflation expectations, determine the true cost of holding non-yielding assets. When real rates are negative, meaning inflation exceeds interest rates, silver becomes a wealth preservation tool. When real rates are positive, meaning interest rates exceed inflation, silver faces structural headwinds. Current real rates sit near 1.5% positive, but declining. This creates a complex environment. Positive real rates suggest silver should face selling pressure. But declining real rates suggest that pressure is easing. The market is caught between what is and what might be coming. Adding another layer of complexity, the US dollar. Silver is priced in dollars globally, so dollar strength directly impacts silver's attractiveness to international buyers. During the February correction, the dollar index rose approximately 0.6%. Not a massive move, but enough to create marginal pressure on dollar-denominated commodities. Yet, here again, the narrative breaks down under scrutiny. By the time silver completed its recovery, the dollar had risen another 0.3%. If dollar strength was truly driving silver lower, the recovery should not have happened while the dollar was still strengthening. This brings us to the uncomfortable truth most analysts avoid. Markets are not simple cause and effect machines. Multiple forces operate simultaneously, often in contradiction, creating outcomes that no single narrative can explain. The Fed matters, the dollar matters, but neither determines silver's path alone. What determines silver's path is the interaction between monetary conditions, physical demand, technical positioning, and structural market architecture. And it is that architecture, the plumbing beneath the surface, that holds the real answers to what happened in February. Charts do not predict the future. They reveal what already happened. And sometimes, if read correctly, they whisper what might happen next. Silver's chart in early February was whispering something very specific, but most traders were too busy listening to the noise to hear it. On January 28th, silver touched $32.17. This was not a random number. It was the exact level where silver had failed 3 times in the previous 8 months. Each time price approached this zone, selling emerged, pushing it back down. Technical analysts call this resistance, but resistance is just a polite word for memory. Markets remember where participants felt pain, where they made mistakes, where they swore they would exit if given a second chance. $32 was one of those levels. When silver approached it again in late January, the same pattern threatened to repeat. Except this time, something was different. Volume. The rally into $32 occurred on declining volume. This is a warning sign that experienced traders recognize immediately. When price rises on strong volume, it signals conviction, broad participation, sustainable momentum. When price rises on weak volume, it signals exhaustion, narrow leadership, vulnerability. Silver's January rally showed all the classic symptoms of a move running out of energy. Fewer buyers were willing to chase it higher. Existing holders were beginning to consider exits. The market was begging for a reason to correct, and on that Tuesday morning in February, it found one. The technical breakdown was textbook. Silver fell through $31, a support level that had held for 3 weeks. Then it fell through $30.50, another support level from mid-January. Then it touched $30.02, paused, and reversed. That $30 level is where the story gets interesting, not because it is a round number, though round numbers do carry psychological weight, but because $30 represents something much more significant in silver's structural history. Since March 2024, silver has tested the $30 level 7 times, 4 times from above, 3 times from below. Each time, the level held. Buyers appeared whenever silver touched $30. Sellers retreated whenever it bounced from $30. Over 11 months, this level had become the single most important reference point in the silver market. It was not just support. It was the line that separated bullish structure from bearish structure. Above $30, silver was in an uptrend. Below $30, everything changed. When silver touched $30.02 on that February morning, every technical trader watching the market held their breath. A decisive break below $30 would invalidate months of bullish structure. It would trigger stop-loss orders sitting just beneath that level. It would signal that the entire rally from October 2024 was over. But the break never came. Silver touched $30, held for 90 minutes, then reversed with force. This is called a successful retest, and in technical analysis, successful retests are among the most reliable signals that exist. Here is why that matters. When a support level holds under pressure, it does not just maintain the status quo, it strengthens. Each failed attempt to break support adds to the level's credibility. It proves that buyers are willing to defend that price, even when conditions are unfavorable. Silver's defense of $30 in February was particularly significant because it occurred during a broad risk-off move across commodity markets. Copper fell, crude oil fell, even gold, silver's closest relative, showed weakness. Yet silver found buyers at $30. This divergence suggested something important. The bid at $30 was not speculative, it was strategic. Volume analysis confirmed this interpretation. The heaviest volume during the entire correction occurred in the 30 to 30.20 range. Millions of ounces changed hands in that narrow zone. This was not panic selling into a void. This was absorption. Large participants were accumulating silver at prices they considered attractive, while smaller participants were liquidating in fear. This is how market bottoms form. Not with fanfare, not with confidence, but with quiet accumulation during chaos. The recovery phase showed equally important technical characteristics. Silver did not grind slowly back above $31. It jumped. Within 6 hours of the low, it was trading at 30.80. Within 24 hours, it was back above $31. The speed of recovery is critical. Slow recoveries suggest reluctant buying. Weak conviction, fragile structure. Fast recoveries suggest aggressive buying. Strong conviction, durable structure. Silver's snapback was fast, but speed alone does not confirm a bottom. Confirmation requires multiple conditions to align simultaneously. First condition, price must reclaim the breakdown level and hold it as new support. Silver needed to move back above $31 and stay there. By Friday, it had done this. Second condition, volume must remain elevated during the recovery. Silver's bounce occurred on above average volume. This confirmed genuine buying interest, not just short covering. Third condition, related markets must confirm the move. This is where the analysis becomes more complex. Gold, silver's larger and more liquid cousin, showed a similar but less dramatic pattern. It declined during the same window, but its decline was smaller, approximately 2% versus silver's 4%. Its recovery was also smaller. The gold to silver ratio, which measures how many ounces of silver equal 1 ounce of gold, spiked during the correction. It reached 92 to 1, meaning 92 ounces of silver equaled 1 ounce of gold. Historically, ratios above 90 suggest silver is undervalued relative to gold. When this ratio spikes and then reverses, it often marks turning points in silver's favor. The ratio peaked at 92, then fell back to 88 within 3 days. This was the third confirmation. Silver mining equities provided the fourth piece of evidence. Major silver producers, companies like First Majestic and Hecla Mining, fell harder than the metal itself during the correction. This is normal. Mining stocks amplify the volatility of the underlying commodity. But their recovery was equally amplified. By week's end, several mining stocks had not only recovered their losses, but posted new monthly highs. This divergence, where stocks lead the metal higher, is often a precursor to sustained rallies. 3 technical conditions aligned: successful defense of major support, high volume reversal, confirmation from related markets. By strict technical standards, this qualified as a bottoming structure. But technical analysis cannot answer the deeper question. Is this the bottom, or simply a bottom? That answer lies not in charts, but in the machinery beneath them. There is a war happening in the silver market that most people never see. It is not fought with headlines or press releases. It is fought in the silent machinery of futures exchanges, margin accounts, and warehouse receipts. And what happened in February was not a battle. It was a massacre. Every Tuesday afternoon, the Commodity Futures Trading Commission publishes a report called the Commitments of Traders. Most investors ignore it. Professional traders study it obsessively. This report breaks down exactly who holds what positions in the futures market, categorized by participant type. Commercial hedgers, producers and industrial users who trade to manage business risk. Large speculators, hedge funds and institutional traders seeking profit. Small speculators, retail traders and individual investors. The report published on February 4th, 3 days before the correction, showed something remarkable. Large speculators held net long positions equivalent to 218 million ounces of silver. This was the highest level recorded in 14 months. Commercial hedgers, the producers and banks, held an equal and opposite net short position. This is normal market structure. Speculators bet on price increases. Commercials hedge against them. But the magnitude of this imbalance was not normal. It was extreme. When speculative positioning becomes this one-sided, the market enters a fragile state. Everyone is leaning the same direction. There are no new buyers left to push prices higher, and if anything goes wrong, there is no one positioned to absorb selling pressure. This is called a crowded trade, and crowded trades do not end gently. They end with violent unwinding, forced exits, and margin calls. February's correction was that unwinding in real time. Here is how the mechanics worked. Silver futures are highly leveraged instruments. A trader can control 5,000 ounces of silver, worth approximately $150,000 at current prices, with initial margin of only $8,000. This is nearly 20 to 1 leverage. When silver rises, this leverage magnifies gains spectacularly. A 5% rally doubles the trader's margin account. But when silver falls, the leverage works in reverse. A 4% decline does not just reduce the account by 4%. It wipes out 50% of the margin deposit. As silver fell through $31 on that Tuesday morning, thousands of traders received margin calls. Their brokers demanded additional capital to maintain their positions. Some deposited more money. Many could not. Those who could not were liquidated automatically. Their positions were closed by the exchange, regardless of their long-term conviction, regardless of their analysis, regardless of whether they believed silver would recover. The system does not care about beliefs. It cares about capital. And when capital runs out, positions disappear. This forced liquidation created a feedback loop. Selling triggered more margin calls. More margin calls triggered more selling. Within hours, the speculative long position that had taken weeks to build was being dismantled in a chaotic cascade. But here is what makes this particularly important. While the paper market was liquidating in panic, the physical market remained completely calm. Dealers who sell physical silver coins and bars reported no unusual activity. Premiums, the markup over spot price that physical buyers pay, stayed steady. In some cases, they actually increased slightly as buyers saw the lower prices as opportunity. This disconnect reveals the fundamental tension in silver markets. The futures market, where most price discovery happens, trades contracts representing silver. The physical market, where actual metal changes hands, trades real silver. These two markets are connected, but not perfectly. And in moments of stress, they can diverge dramatically. During February's correction, futures contracts representing hundreds of millions of ounces traded hands. But actual physical silver barely moved. The vast majority of the selling was not from people who owned silver and wanted to exit. It was from people who owned leveraged paper contracts and were forced to exit. This raises an uncomfortable question for anyone trying to understand where silver goes from here. What happens when the physical market finally catches up to the demand that paper markets keep suppressing? The answer may be emerging already. Data from the U.S. Mint shows sales of American Silver Eagles, the most popular silver coin in the world, increased 17% in January compared to December. Sales in the first week of February, during and after the correction, were the highest weekly total in 11 months. Retail buyers were not scared by the volatility. They were energized by it. Industrial demand tells a similar story. Silver is not just a monetary metal. It is critical for solar panels, electric vehicles, electronics, and medical equipment. Global solar installations are projected to grow 23% in 2025. Electric vehicle production is expected to increase 18%. These are not speculative forecasts. These are orders already placed, factories already built, supply chains already committed. The industrial bid for silver is structural, predictable, and growing. Yet this demand barely registers in futures market pricing. Why? Because the futures market is not designed to reflect long-term industrial demand. It is designed to facilitate short-term hedging and speculation. The participants who dominate futures trading, algorithmic funds, momentum traders, short-term speculators, operate on time frames measured in days or weeks. The participants who dominate physical demand, solar manufacturers, electronics companies, national mints, operate on time frames measured in quarters or years. These two groups are playing entirely different games. And the game being played in futures markets is the one that sets the price everyone sees. This creates opportunity and risk. The opportunity is straightforward. If physical demand continues growing while paper markets remain volatile and sentiment-driven, the gap between paper price and physical value will eventually close. When it does, the adjustment will not be gradual. It will be sudden, dramatic, and heavily tilted in favor of those who positioned before the gap closed. But the risk is equally real. What if another wave of forced liquidation hits before physical demand asserts itself? What if margin requirements increase further, triggering another cascade? What if a broader financial market shock drains liquidity from all risk assets, including silver? These scenarios are not hypothetical. They have happened before. March 2020 saw silver fall 27% in a week, despite no change in physical fundamentals. The cause was pure mechanics, liquidity seizures, margin calls, forced selling. Physical demand was irrelevant in that moment. Only cash mattered. So the final question remains. Is this the bottom? The technical evidence says possibly. The physical market evidence says probably. But the structural evidence says it depends. It depends on whether another liquidity event strikes the financial system. It depends on whether speculative positioning rebuilds to extreme levels again. It depends on whether the Fed's policy path shifts dramatically. And most importantly, it depends on whether physical buyers become aggressive enough to overwhelm the paper market's ability to suppress price. That last factor is the wild card. Because unlike margin traders who can be liquidated, unlike speculators who can be shaken out, physical buyers are patient. They do not panic. They do not need leverage. They simply wait for prices they find acceptable, and then they buy. February gave them exactly that opportunity. Whether they took it in sufficient size to change the market's trajectory will become clear in the weeks ahead. Until then, silver remains what it has always been, a market caught between paper promises and physical reality. And historically, reality always wins. The only question is when.